Hello, welcome to this Ned Davis Research Podcast, where we will help you see the signals. My name is Brian Sanborn, NDR's Global Head of Investment Solutions. In this episode, we will be speaking with NDR's Chief Economist, Alejandra Grindal, about the state of the global economy. Alejandra, are conditions improving or weakening, and what impact could it have on equities?
Well, hello, Brian. So happy to answer that question. Most of the world's major economies have shown signs of slowing. Tariff risk remains the biggest and most common obstacle to growth. The good news, though, is recession doesn't appear on the horizon anywhere, and that supports the global economic expansion and this ongoing bull market in equities we've been in. Among most of the economies we monitor, inflation is either contained or heading lower. As a result, most central banks are in easy mode, and that's yet another historically bullish condition for global equities.
And what is the state of the US economy?
So we continue to expect below trend growth in the US economy. The job market clearly has been showing signs of softness, and outside of AI, ongoing policy uncertainty has kept a bit of a lid on business spending. But just like the global economy, the risk of recession in the US remains low for now. The Fed's September rate cut, followed by at least 2 more reductions this year, should provide support to the economy. The US economy is currently in a slow growth and low inflation period. And while the best period for equities has been Goldilocks, so that's that strong growth and low inflation, this period that we're in right now has historically still seen a decent outcome for US equities.
Europe has been flirting with recession for the last couple of years. What has changed?
So we are seeing signs that the Eurozone economy has finally gotten out of its rut. Economic growth has not only been positive, but it's been broadening. So one thing we like to look at is the composite PMI, which generally tracks the region's GDP, but we get a little sooner and it's monthly. It's held in expansion territory for every month this year, and that's the longest winning streak since the first half of 2022, which recall was when Russia invaded Ukraine and obviously had negative implications on the European economy. On top of a growing economy, we're seeing also some signs of a manufacturing recovery. Sentiment is improving. Fiscal support, especially in defense and infrastructure from Germany, is coming. Inflation appears to be contained, and monetary policy is easy. At the same time, the region will still face much higher tariffs from the US, and this does affect certain major industries. Political uncertainty abounds, and this is globally, coming from the United States, also Russia, and of course, some domestic issues like what we're seeing in France. And again, this is on top of low potential growth, which limits the region's sustainable economic growth. So for now, you kind of put those things together. The balance of risk suggests that the chance of recession in the Eurozone is low.
Lastly, what are the economic outlooks for Japan as well as China?
So Japan's economy has held up better than expected in the first half of the year. In fact, at one point, recession was actually a possibility, but we saw upward revisions to GDP. This includes a 2.2% annualized gain in Q2, not bad. And that essentially eliminated the threat. The outlook has become a little less clear. The composite PMI is still in expansion territory, but it fell to a 4-month low in September. Also, our Japan economic timing model has fallen back into stagnation mode in recent months. We're also seeing some political uncertainty, so that could weigh on the outlook as well. But to me, inflation is kind of the bigger story in Japan. It has held above the Bank of Japan's 2% target since the first half of 2022. And this is the longest streak above that threshold since the early 1990s. Recall that's when the lost decades began. So this, along with the economy holding up better than expected in the first half of the year, really supports our view for gradual normalization by the Bank of Japan. We expect another rate increase from the Bank of Japan sometime in the last quarter of this year. Now, turning over to China, because you asked about them. After a strong first half, when China's GDP grew above the government's 5% growth goal, economic data for July and August has seen activity weaken more than anticipated. Looking at data from consumption, production, lending to investment have really seen some of their worst readings this year. And as a result, the Citigroup Economic Surprise Index, which just on balance tries to gauge data versus what economists' expectations are, it dipped into negative territory in August for the first time since February, and it's now at its lowest level in nearly a year. One thing China continues to struggle with is deflation risk. It has experienced little to no growth in inflation for pretty much 2 years, and a lot of that is just due to weak domestic demand. As a result, businesses have been slashing prices to gain market share. The government has actually been urging businesses to pare back competition to help, circumvent this risk of falling into a deflationary trap, very similar to what we saw in Japan in those last decade periods. And the fading of consumer stimulus and falling home prices just sort of suggests domestic demand will remain weak in the absence of really large stimulus. So with the latest economic data fading, we do expect more easing from the People's Bank of China, that's the central bank, and greater utilization of already planned fiscal expenditures. But just given that strong first half of the year where growth was actually above the government's 5% target, the government is really unlikely to step in with significantly more stimulus unless the economy slows a whole lot. And it just hasn't gotten to that point yet.
Alejandra, thank you for your insights. NDR clients can read Alejandra's research notes in her global economic focused publications. The indicators Alejandra and the research team developed for our subscription service are also used in our model portfolios, which are available for direct delivery on TAMPs as well as ETFs. For more information on NDR, we encourage you to visit ndr.com. Also, for those listening in audio-only mode, video versions including the charts of See the Signals are available by going to info.ndr.com/ndr-signals. Thank you for joining us as we help you to see the signals. So long.